We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chris Rutherglen, PhD level scientist and engineer and publisher of the Gold Investor Research Substack. Chris, how are you today?
I'm good, Tom. Good to be back.
Excellent to have you back. And, I really appreciate getting to speak with you because of the, let's say, the accuracy and thorough nature of your work. I really like digging into it because you really investigate the drivers of the gold price and show your work. So you recently updated some of your framework for understanding the price of gold on your Substack, and I'm looking forward to going through that update with you today. So just to review, the first assumption that you worked off last time was that the market value of the world's investable gold supply is proportional to the market value of the USD money supply, right? So maybe starting there, we can, extrapolate from that equation as you've written it and updated that framework, right?
Sure. Yep. Let me just share my screen here so I can bring up some stuff. So the article which I published on Substack, towards a comprehensive framework for understanding the gold price, is available for free, so anyone can read it. But yeah, so the idea from the start and what sort of motivated me for doing a lot of this stuff is to understand what's going on in the gold market. I started investing in it in, say, 2003, and then later on with the stocks and what have you.
Mhm.
And I think at the beginning, for me and perhaps a lot of other people, is that it's kind of like riding a roller coaster blindfolded if you don't know what's going on, because you got a lot of ups and downs. And I would like to, and I'm working towards it. I'm not quite there yet, but taking that blindfold off and sort of anticipating these changes in the price and what drives it up and what drives it down, and having some sort of foreknowledge on what to expect. So that's the motivation for doing this. And so I've been on the program a couple of times, and one of the things that sort of got me going on this was this first assumption. So there's two assumptions that sort of made things start to get the ball rolling, and I just pulled on those threads and instead to see where it leads. So the first assumption, yeah, as you mentioned, is so the market value in world's investable gold supply is proportional to the U.S. money supply, M2. So what does that mean? So what that means is that when you do the math on it, you can take some historical gold price in the past, which is G at T0, and then project that into the future, or forwards and backwards in time. And the scaling function is just 1 plus the money supply, the growth in the money supply, divided by 1 plus the growth in the gold supply.
Mhm.
And then from that, you can project forward what it is at some other time, just regular T. So in picture terms, what does that look like? It looks like the following here. So this is looking back from 1920 to present. So we have over a 100-year look back from so we're at 2023 or 2024, but dated 2023 to 1920. And you can see it roughly follows it. And what we're doing in this case, so if we look at this dark green line, so we're taking the $35 an ounce price from 1934. So Roosevelt revalued the gold price at that point during the Great Depression. And we're just projecting that forwards in times using that scaling function that we just showed on the previous screen. So if you take that $35 an ounce price, translate it forward to today, it's going to be closer to a $4,000 gold price. So that's really what it does. It doesn't really, this method is not to say that you can predict what the gold price is going to be at any given time, but it gives you a way to get a sense of, are we at the cycle high, cycle low, or towards the mid-cycle level. So I did this originally for 4 different levels: the cycle high, another one I called the mid-high cycle, which is the 2067 price from 1932. So this is right before the revaluation. So you can see it right here. So it kind of intersects there, and it sort of scales up, and that's around 2168 as of November. and it is a mid-cycle, and it is a cycle low. But that's pretty much it. And then we can see it tracks it. Now, if you had done this based on just scaling based on the change in the money supply, it wouldn't look this way. It wouldn't track it as well. You would see a trend, a deviation, a divergence between the two.
Mhm. Yeah, it's
So if we
interesting.
zoom in, oh yeah, go ahead.
I was going to say it's interesting too to really be looking at this and be able to kind of determine times in history where, you know, based on these bands where gold is, tends to be undervalued. And, let's say take January 1st, 2000, for example, or thereabouts, and be able to understand that we're near a cycle low and invest at that time, right? That's
Right. Yeah,
just stepping back. It seems instructive from that perspective.
it is. Yeah, and also I think when we get further into this, we'll see that there's another indicator that highlights this point as a low and this point as a high. And you don't need to use technical analysis. It's sort of based more on the fundamentals of it. So if we go forward, so we look at a smaller segment of time. So instead of looking at a 100-year look back, we'll just do a 23-year look back. So starting in 2000. So it's basically the start of the current bull market and the gold price. Now here you can see it's actually reacting. Like we have a high here, a local high at this mid-high cycle, another one here. And when I did this, I didn't anticipate that it would be these reoccurring support resistance levels.
Mhm.
That wasn't the intention, but it just happened that way. And we'll go into it. There's other ones that are sort of hidden in the data, but also at the mid-cycle level, we see 1, 2, 3, 4 tests this mid-cycle level just in the past 10 years. So usually when it gets down there, then you can say, well, that's probably going to be close to the low, the cycle low, or the local low at that point. But again, we're looking at this and we can see that it's generally tracking the price. So that scaling function is working pretty well. Another way to probably bring it out to extract it even better from the data is to take the ratio or normalize the gold price to this mid-cycle level. So if you take the gold price divided by this line here, which is the mid-cycle level, if it's at the mid-cycle level, that ratio is 1. Mm-hmm. If it's higher than it's going to be greater than 1. If it's less than, it's less than 1. So here we can do that. Just do that division, normalize the gold price to mid-cycle ratio, and you can really see it tracks it pretty well. And you can see these reoccurring support resistance levels. So this 38%, levels or bands. I usually call them zones or bands because I sort of give it some leeway. So it's 38% plus or minus 2% above the mid-cycle level. And you can see it hit it here, and I think that's 74, end of 74. And in the mid-80s, then we have 2008, March 2008, and then another one is August 2020 when it hit it, and then that was its local high. And then similarly for the mid-cycle level, which is 1, the one on this chart. And then another one, there's some more sort of recurring support resistance zones at 10% below the mid-cycle level. So we have one test of it right here, and this is at the global financial crisis, the GFC lows in October of 2008. But you have other ones, here, here, and here. So we see that
I was going to say it's interesting over time how it almost becomes more well behaved, more contained within that support and resistance level.
Yeah, I mean, at the time when you're looking at or when you're investing in it, obviously it feels like it's a roller coaster.
Yeah.
But yeah, when you look at it, you do see the order, and this is a long-term order. This is 50 years, 53 years of order, and if you normalize it to other things such as as moving averages, you won't get it to this extent. And I think because this way is sort of an intrinsic way of looking at the gold price in terms of how it scales with time. And then we'll get into more of that, perhaps why that is later on. But just looking at the data and empirically, it looks like this is the correct way to look at it. Yeah. So we can zoom in. So instead of looking at that 23-year period, we can zoom in, just look at the past 10 years, and then we can extract even more of these reoccurring support resistance zones. So we've already looked at the 38%, which, technical analysts will know, isn't 38% one of those Fibonacci retracements, which it is. I mean, I didn't intend it to be there, but that's just what the data shows. And then, the mid-cycle level. So these two we've already looked at, but there's two other ones that seem to be repeating over time, like 29% and plus 19% above the mid-cycle level. Right now, the gold price is sort of bumping its head against the ceiling on its 29% level. And if I just jump ahead to the next slide, we can see it in a little more detail, just looking at the past 2 years. So that's kind of where we're at. It's getting ready to break, but it needs us a little bit more time to make that push over. But so we can look back at this, so we see a cycle high, intermediate cycle high that goes up to the 19% level, comes down, reaches a low. So this is that triple bottom low around 1620 in September, October, November of 2022. And it was pretty much within, a few percentage of the mid-cycle level. Then it comes back up to 19%, down, makes a high at the 29%, down. This low is at the 3-year moving average, and now we're back up to 29%. So, there is order to it, and I'm trying to hopefully sort of use it to anticipate what the next move is and where the next perhaps stop on the bus ride is for the gold price. Yeah. And the last thing one could do with this is just take these levels that are the reoccurring support resistance zones and just map those back onto the actual gold price chart. So here's the gold price chart shown here with the shaded regions around the gold just being the highs and lows. So instead of those support resistance levels being constant like they were in the previous chart, they're moving because, in the price sense, in the price perspective, they actually are moving. The 38%, 29, which is where we're at right now, at 19. And you can also map on the other measures that, say, a technical analyst may use, like exponential moving averages. So we have the 100 and 200-day exponential moving average. You can use the 3-year moving average and different levels above 3-year moving average that tend to repeat. And you can sort of box things in and see where the next likely level is that the gold price could find support. So that's kind of what we get from that assumption one. So assumption one, when I first came on the program and was first doing this, I was sort of on the level one, and I got to level 2, level 3, and I got further on into this, and you can extract a little more stuff, and which leads to the second assumption, which is gold price is inversely proportional to real yields. Now, most people think, that's everyone knows that, and it's true, they do, but usually the analysis just goes to that first step on this, but not pulling that thread a little more to find out what really the implications are throughout time.
Well, and
so that's
Chris,
kind
if
of
I can just interrupt you for a sec here. That's what I appreciate about your work, is that it's very, it's very scientific. Obviously, you're an engineer, a PhD engineer, and it is, you approach this from a very scientific and math-based background rather than, having a lot of room for different interpretation, right?
That's right. Yeah, you just look at the data and let it try to speak for itself, and not introduce too much narrative. Because in a sense, that's kind of what you do, as you mentioned, in engineering and science. You really can't just, as maybe in business or other things, where you could just talk your way into certain things. It doesn't work without the real data, the hard data to support it. No one's going to take you serious. No one will take you seriously in engineering and science and what have you if you did that. So that's kind of the way I was trained to think about things, and that's kind of what I'm applying to this. And just so everyone knows, I'm not a professional. I'm not in the profession of investments in finance. I've never really taken a course other than an accounting course once as an undergraduate in options derivatives, but it's all sort of stuff I've come up with on my own in some sense, and just learning from others, and then a little bit from the CFA coursework that I had done in the past. But yeah, so assumption 2, gold price inversely proportional real yields. So typically when that is shown, it looks like this. So you just a straight overlay. So on one axis, we have the gold price, and I've shown it on a log axis, or log scale rather. And the other one on an inverted scale is the 10-year real yield, the TIPS 10-year real, which is Treasury Inflation-Protected Securities. So by inverted, I mean that the negative yields are on the top and the positive yields are on the bottom. And you can see it overlaps pretty well with the gold price. But the time frame we're looking at here is 2009 to 2022. So for that period of time, it looks like
that data set has changed over time, right?
Yep. Well, yeah. So if the match works, or the correlation fits well when you look at it this period of time. If you look at other period of times, it doesn't work as well, and we'll get into why. But yeah. So most people when they plot this, obviously after 2022, there's a large divergence, which I haven't shown here, and there's also divergences before the 2009. But just to stick with this for a moment, if you're going to translate a log gold price to a yield, actually, let me step back. So a lot of people, they'll represent the gold price on a linear scale, which is not the correct way to do it. And the reason is because when you're comparing a price to a yield in finance, those are related through exponentials, because it's a compounding effect. So you would want to do it on a log scale would be the true way to do that. And if you do it through a log scale, then it's exponential. And the relationship, if you're going to relate this left axis, the gold price, to the right axis, which is the real yield, it would have to take the form of something like this equation above. So G would be the gold price, C would be the coefficient in front of it, and which the coefficient, all it does is just moves the gold price up and down relative to the real yield. So it just shifts in the vertical. And then we have exponential e to the negative 22.4. So the negative 22.4 would be called the real duration. Now, many people probably heard the term duration in reference to bonds. So like a long duration asset or long duration bond is like a TLT, or a 30-year treasury, or a 10-year T-note. So why do they call them long duration? So long duration essentially is capturing the internal leverage that you get for a change in the yield. So if the yield changes by a little bit, you're going to get a lot more change in the price if the duration is bigger or larger. So a 30-year bond, which has a higher duration, is going to have a small change in the yield. It's going to have a larger change in the price relative to that of, say, a 2-year T-note or a bill, which is very short in maturity, and it will have a small duration. It's going to have a very small change in the price for a given change in the yield. So what this is basically saying, so when you do the fit, the coefficient C comes out to around 1525 when you do it like this, when you do this just straight overlay. And the real duration comes out to around 22.4 years. And that's just saying, if I put it a smaller number, what we would see is it would be let me get the screen pointer here so I can, here we go. So if it were a smaller number, you wouldn't see the highs and lows matching up. It would look too small. So you just have to scale it right, and then it comes out to around this number. So then the next question is, all right, so this is the overlay, and this is what they typically do. Is this right? Is the coefficient going to be constant throughout time? Is the duration going to be constant throughout time? And not necessarily, because right now it's just sort of empirical. There's no fundamental reason why any of these numbers matching. Obviously, there's a correlation between the two. But obviously C, so if we think about C, would 1525 be the right number for the 1970s or the 1980s or 90s? Probably not, because what's this coefficient C does is it sort of accumulates the effects of inflation. So the cumulative inflation that builds up in all prices, not just the gold price, but all prices, it needs to be reflected in this coefficient.
Mhm.
So in order to solve this, you need to do one of two things. You need to do episodic adjustments, meaning maybe for this period of time, for this, what we're showing here, 2022 or 2009 to 2022, you have one value for this C coefficient, or maybe at a different period of time, you have a smaller value, and in a time even further back, you have an even smaller value for it. Or you just do a continuous adjustment in this coefficient C through all time. So the latter is what I did. So just the continuous adjustment. So I think that's the way to solve it. But just to highlight the problem, we can go to this and look at if we kept that 1525 as the coefficient and everything else the same, here's what it looks like for that period before 2009. So 2003 to 2009. So you can see, it's the highs and the lows right here. There you have a high and high and high. So it's mimicking it to some extent, but there's a big separation here, and it slowly converges over time because eventually that cumulative effects of inflation is embedding itself in the price and then bringing it into alignment. So in other words, that one value for that C coefficient needs to adjust with time, and that's kind of what the next step is. So how would one do that? So as we discussed in assumption one, we got all these different levels. So one was the mid-cycle level, which is shown here in blue, and then you have the gold price on this log scale going back to 1970. So you can see it follows the gold price pretty well. So why not use that as our coefficient for the gold price in this representation of its relationship to real yields. So we'll keep the duration the same, 22.4, and just see where that leads us. So what do we have? So we know the gold price at any given point. That's the market price. We know the mid-cycle level because that's based on the money supply and historical prices. But it's the blue line right here. So what we don't know is the real yield for gold. So here's the real yield in simplified terms. There's a more complicated version, but I'll skip that for now, and one can just refer to the article to see the full version. But so you have a 10-year yield. So that's it again. It's a market price for that, or market yield. So the only unknown is this, what we'll call the inflation expectation, gold's inflation expectation. Sure. So in other words, you can take gold and look at it from a dollar perspective or dollar domain, or you can look at it from an inflation expectation domain. So it's the same information is imparted. It's just a different picture or different perspective. In engineering and physics, it's common to do this kind of operation. Like, for example, if you have a waveform, an arbitrary waveform, it's very common to look at it in two different domains. One is the time domain, and the other is the frequency domain. And you can transform from one to the other by just a mathematical operation. And the reason they do that is because it gives a different perspective, and it sort of pulls out and lets people see a different perspective that's not as easily apparent as it would be if you looked in one versus the other. So obviously in the frequency domain, you're going to see where the frequency is at. But that's kind of what we're doing here. We're just looking at it from a different perspective and trying to look at the gold price from that point of view. So everyone's comfortable with the dollar gold price, and they're probably not as comfortable with looking at the gold as it's reflected in its inflation expectation. But let's see where it takes us. So again, we know each of these: gold price, the mid-cycle level. We know the 10-year yield. So all we need to do is solve for this, and then we can plot what the gold price is. So let's start. Let's see if this works. So here's from the 1970s. So this chart starts August 1971 when Nixon closed the gold window and gold became a little more free trading. And we're comparing it. So we have the gold inflation expectation, that term that we just talked about in gold here on this chart. And in shaded gray, we have the CPI year-on-year inflation rate. So when at the August 1971, the CPI rate is around 4%. And according to the calculations, the gold price was implying an inflation expectation around 2%. But by the end of 72, 73, you see that the two are almost overlapping each other. So they're both going up and they're trending upwards together. Then we have a dip down, and the gold inflation expectation sort of saturates around, say, 9%, whereas the CPI inflation rate comes up to around 12%. So there is some difference between the two. So CPI is looking at more backwards looking. It's looking at the inflation, the CPI index at that date, and then looking back what it was a year prior, as opposed to gold inflation expectations are more looking or more forward looking. What is it expected to be over some period of time in the future? So they're slightly different measures, but as we see here, they're really following the same form. So then it starts to come down. Both of them come down together. They reach a low, a plateau, or a trough rather, and then they come up together. They come up, and it's not until the CPI inflation rate gets up to the same height as around 12% as the previous peak that happened in 74, peaked in 74. Then we see a divergence. We see that the gold is starting to price in a lot more inflation expectations than is in the CPI. So it's as if the investors are becoming a lot more concerned and fearful of inflation, and so the CPI is already almost at a cycle high here. So it's at almost 15%, and then gold said, well, we're going to price in 19%. So it's even on top of that. So there's excess on excess. So this is an indication that it's probably excessive, which probably means the price is excessive. It's pricing a little too much. And as it turned out, that was the case as we look back on it. So here's a way to use fundamentals to sort of pull out that 1980 price was excessive. And you can sort of use that in the future to, when a similar situation happens, maybe you can say, it's probably excessive at that point too.
Again, just as a guide to where current prices are, if you're trying to, enter in at a time when it is undervalued, or let's say underbought or underloved, right?
That's right. Yeah. So for investors, it's probably much more useful than maybe traders, because they're more in and out at a higher frequency, quicker time frame.
Yeah, that's a great point.
Yeah. But let's just move forward. We can move forward to the 1980s now and see what happened there. So what does that story tell us about that? So in the 1980s, the CPI reaches its peak in the early 1980s, and it comes down around, say, 4%, and it sort of fluctuates between, say, 2 to 6, it looks like. The gold inflation expectations continue to stay elevated. You can see it was well at a premium. So perhaps because of that previous decade of the 70s, where inflation was just came out of the blue and blew people's minds, that they were always sort of looking around every corner and expecting the inflation to come back as the next sort of cycle up. This obviously went in cycles, and it looks like that took a long time to sort of extract from the market. So it took 2 decades for that to dissipate, this premium. But eventually it does. It dissipates, and then now it's at a discount. So gold's actually pricing in less inflation than the CPI is at that time. And when did that happen? That happened in 2001. So right as the gold price is reaching its low, we have another indicator. So we highlight the top when it's excessive, and we see highlight the bottom or the low when the gold's pricing in less inflation. even though it's only at 2%. So it's already at a low, the CPI, and it says, well, it's going to go less than that. So there's another reason why this could be useful to look at this perspective, especially for sort of long-term oriented investments. So stepping forward to the next two decades. So this is the 2000 to present. And starting in 1997, there was a new inflation measure, which was the 10-year TIPS break-even inflation rate. So that's shown in a black line here. And then we also have the CPI rate just for consistency. And then in gold, again, it's the gold-based inflation expectation. Now you see that by 2001, they've converged, and the gold inflation expectation tracks the TIPS break-even inflation rate pretty good. So 2001 to 2002, 2003, 2004, and the first half of 2005, it's still tracking. And by September of 2005, something happens. You get a large divergence. It just goes up from, say, 2.5% to about 5.5%. So 3% increase or premium on the TIPS break-even inflation rate. All the while, the TIPS just continues to stay, inflation rate continues to stay constant, sort of oscillating around that 2.5% level. So what happened at that point in September 2005? Well, at that time, we see that there was a spike in inflation up to 4.7%. And if you look back, that was the highest inflation, year-on-year inflation rate for the CPI going back 14 years. So, now 4.7% may not seem like a lot, but I would imagine back then it was probably headlines that inflation is quite high. So you could perhaps say that that's a potential cause for this divergence to develop. And you can see even as the CPI, so it spiked up, came down, spiked up, and it stayed down for 2006 and 2007. But the inflation premium into the gold price maintained itself. So it stayed high, above 4%, and it just trended higher until you got a second inflation spike on the CPI. And then we get the global financial crisis where we get the drop here. And then there's ultimately a peak in the gold inflation expectation in 2011, sort of coinciding with this last spike up in inflation in 2011. And then we see it dissipate. So from 2011 all the way to 2021, it sort of dropped it all off, all that premium, and it actually traded at a discount again. So it goes at a discount to not only the CPI inflation rate, but the TIPS inflation rate. And then what happens then? So going into 2022, we have another inflation spike. So this one's caused by the response, the fiscal and monetary stimulus that was in response to the COVID shutdowns and all that stuff. And then again, we get this divergence that develops. So we have sort of and actually we see it come down. So then the CPI comes down, but the premium that the gold price is reflecting maintains itself. So it's almost like a perfect analog to what we saw in 2005 and then what continued on. So what's the next step? So next thing I was thinking, well, let's look at that difference here, this premium. So we have the TIPS having its own measure of inflation. And I don't know, it just seems to be out to lunch most of the time because it doesn't do anything. I mean, like here, CPI is at 9%, but the TIPS inflation rate only gets up to 3%, and it just gives it all back up and goes down to 2%, as if nothing happened. So I don't know if this market is managed or what, but it's not really reflecting things. Now, there is a structural reason, which we'll get into, on why I think it's not going to reflect as much of the real inflation that's actually in that happens, but it still can't explain all of this. But anyway, so let's look at the difference. So we have the gold inflation expectation and the TIPS. So let's look at that difference here in this next chart. So this is basically subtracting the gold line from the black line. And so you can see there's zero premium here. So premium above the tips break-evens until we get that divergence. Then it spikes up and it just trends upwards, and it goes right through the global financial crisis in 2008. You get some volatility and oscillations here, but it just continues up until we get that cycle high in 2011, September 2011. And then it sort of dissipates it out over the next few years until we get down to the discount again, and then we have the spike. So if we were to consider an analog and what the expectation is for this current period, one can expect this premium in the gold inflation expectations to continue probably into the future. Obviously it seems like the inflation is not going to be going anywhere, considering the financial situation or the fiscal situation of the U.S. government and all this stuff, and then what typically happens going into a recession or a slowdown. And so the last thing is addressing that discrepancy I was mentioning between the gold price, the inflation, that's the actual inflation, and the inflation that's represented by the consumer price index. So tips break-evens, well, all the tips, they pay out based on the CPI inflation rate. So if it goes up, or if it's understated, if it's understating the real inflation, then there's no sense in the tips market pricing in the actual inflation rate that it thinks it is, because they're not going to get paid out on that. They're going to get paid out on the CPI rate, which, if it's undervalued or underrepresenting inflation, that's what you're going to get. So what we've done here, I plotted the mid-cycle level again for gold, and then we have the gold price in gold. So the blue line's the mid-cycle level. Gold's the gold price is in the gold line. And it started in 1970. I scaled the $100 mid-cycle level, which was around 100 in 1970. So I scaled it forward with the CPI rate as well. So this pink line here is the CPI scaling forward inflation rate. And you can see they're roughly going back and forth, but they're pretty much following each other up until, say, 1996, maybe 1997, and we start to see a divergence where the mid-cycle level for gold continues higher, while the CPI inflation rate doesn't. And it's basically a 2x difference. So this gets up to around a little above $800. So $100 in 1970, the CPI would say is equivalent to 820 in say December of 2023, as opposed to gold, the mid-cycle level, $100 in 1970 would be equivalent to $1,600. So it's 2x difference. So there's a lot of potential error in the CPI in terms of its understatement of the inflation rate. And I think a lot of people sort of intuitively sense that, and there's probably reasons to think that based on how they do the methodology. But here's at least one data point that suggests, yeah, it looks like they're understating it. So the bottom line is that gold inflation expectations should probably track the real inflation rate of that actually happens, which I think is probably closer to this mid-cycle level, the growth in the mid-cycle level, as opposed to the CPI rate. So there is a reason why the tips break-evens and the gold inflation expectation could diverge over time. So that sets up. So then what do you do? So the whole goal is to really understand what's driving the gold price. So far we just sort of presented a model for looking at it, and so far the model looks like it's accurate. So next step is, let's dive into each one of them and see what's driving at any particular time. So we can take that equation that we just showed. It looks like it's useful. So we have this mid-cycle level for gold. We can say that's one driver. We have the 10-year T-note yield, another one. So it's another input. We have the tips break-even inflation rate. So that's another input. And then we have this gold inflation premium to that of the tips. So this is these two together can be seen as gold's inflation expectation, or you can break them apart as we have here, just to reflect what the tips is doing and what's the premium is doing. Well, do that. So we can basically, since it's in an exponential, you can break it out and into factors. So where the multiple of each of the four factors produces the gold price itself. So that was the next thought to do. So here's the 1970s period. And again, so what we have here in gray, we have the mid-cycle level. It's going up and up and up, and that's reflected on this right axis.
Mhm.
And then in red, in green, we have the T-note factor. So it's not the 10-year T-note yield itself. It's as it's reflected through that equation. So the equation is e to the negative 22.4 times the 10-year yield in the decimal form. And that would give you this 0.25 in August 71. And you can do that for the other factors, and you get them. And if you multiply the four together, you get the gold price at that time. So the what I was looking to do here was to highlight what drove the gold price during particular movements in it. So the movement we'll look at is from the closing of the gold window in 71, August 71, to the actual cycle high that occurred, the first cycle high in December 30th, 1974, when it got up to just under $200 an ounce. So we can look at each of these factors and see what it did. So first factor, the mid-cycle level, what did it do? Went from 115 to 144 for a 25% increase. Okay, so that's a legitimate contributor. The 10-year yield factor went from 0.25 to 0.219, so it went down a little bit. So it's negatively contributed to the gold price. The premium, inflation premium to gold, went down a little bit as well, with obviously some oscillations in between. But from start to finish, it went down. But the big mover, not surprisingly, was the inflation. So inflation contributed the most to the gold price movement in the 70s in this first movement up. It went up 358%, and that drove most of it. How about the movement down? So going from the high to the low that occurred in 76. So again, it's the inflation rate going down was really the mover that brought it down. It went from 12.6 to 3.35. Other factors such as the premium, it actually went up. It went up from about half to almost 1, so almost no premium. The 10-year yield continued going up, meaning the factor went down by a little bit, so that was a negative contributor. And the mid-cycle level went up as well, so that was a positive contributor. But obviously, this one took most of the reason why, or is the reason why it went down. And then lastly, going up again, it was inflation. Actually, I think this last one here, when you go from the cycle low in 76 to 1980, 3 of the drivers were positive for the gold price. So 3 of them were going up, and only 1 was going down. And the only one that was going down was the 10-year yield. So 10-year yield, the 10-year yield was going up, causing the factor to go down. So it's a little confusing, but it went from 0.194 to 0.125. So we had a drop in that factor. But all the other 3 factors were positive for the gold price, and that's where you get that cycle high. And you can see it comes to a little premium here. So Tom, does that make sense? I mean, hopefully I explained that okay.
Mm-hmm. I think you're just showing your work to how you got to, let's say, this actual, let's say, final equation, right? And trying to model how these different, let's say, inflation factors or coefficients map onto predicting the gold price, right?
Yeah. So I guess the way I like to think about it is what's driving the gold price at any particular movement. And if you can see what that is, then you can focus in on what that driver is, and then maybe focus in on that and find out where the stops are, the bus stops are for that. So if say it's the 10-year yield driving it, if it's the one driving the up movement or down movement, then maybe focusing on that and seeing where's a likely termination point for that movement on the 10-year yield. And if you can isolate isolate that, then maybe that will translate forward to when the gold price is likely going to reach its higher low. Yeah.
And of course, understanding that those drivers tend to kind of change over these different, different time zones, right?
That's right. Yep, exactly. So, I mean, this you hear a lot that, the gold price is not correlated to the 10-year yield. Well, it is, but it isn't. But if that's all you're correlating to, if that's what you're doing a regression to, then yeah, it probably won't give you a good R squared. But if you look at it in the totality of the four drivers, then yeah, the 10-year yield sometimes it's a driver, sometimes it's in the back seat. Someone else is driving the bus on that one. So in the 70s, it was the inflation was driving the bus for the gold price pretty much the whole time, and the other ones were taking a back seat. So let's go forward, look at some other instances. And the reason is just to go through these exercises, just to look what happened in the past, what drove the gold price at different particular movements, and maybe it'll be instructive for what happens next in the current markets. So for the next one, let's look at. So this is jump to this chart just to show you where we're at. So here we have the gold price on a log scale. We have the Fed funds rate in dark red. And it's going back to 2000, from 2000 to present. And we also have the 2-year yield here. And I've marked out these different, so the gold price sort of gets in these consolidation zones, or just goes sideways. And then it transitions up to the next consolidation zone, then goes sideways and transitions, consolidate. So you see these movements in it. So let's look at this movement here, because it's sort of kind of an analog to what we're currently at. Because right now we have the peak in the 10-year yield. Yields are coming down, and the gold price is just about ready to break out. So if we look at this period of time, we're going to look at it from the point of this breakout. So basically right here, we're going to look at this movement here. It breaks out in June. I think it's June of 2007, and it reaches a high in March of 2008. So let's focus in on that. So that's right here. So we have June 26, 2007 to March 17, 2008. So what drove that movement? So we look at the factors. We'll look at the 10-year T-note yield factor first. So that one is up 44%. So we can see that's a strong contributor. The mid-cycle level was up 6%. But the tips break-even factor and the golds and premium to the tips was pretty much flat. So they didn't contribute. They're in the back seat doing nothing. And then the two ones, yields dropping was the main driver, and then riding shotgun was the mid-cycle level. And then going forward from the cycle high to the low, so that the global financial crisis low that we had in October 2008, you can look and see, well, the 10-year yield went up a little bit, which was, brought this factor down, but not much. But the main movement was from the tips break even coming down. That drove that movement. And if we look from that low to the ultimate cycle high of September 6, 2011, all four of the factors were in a driver's seat. So it was a crowded driver's seat in this case, but it's a big bus, so you can fit them all in there. But all four of them were going up in that movement to that cycle high. And just lastly, to finish it off with where we're at right now, we can just fast forward and look at the previous two local lows in the gold price. So we'll start with the local low that occurred November 3, 2012. So this is the one that went down to 1620. Is a triple bottom low. And you can just look at this. Most of the downsloping action that we see on any of these is coming from the rise in the 10-year yield, which causes this factor to decrease. And when did the low form for gold? It formed when the 10-year yield stopped going up. So one could have looked at this and said, okay, that's driving the bus. So let's look at the 10-year yield and focus in on that and figure out when it's going to stop. And once it stopped, then that was the bus stop that you're going to get on or off at. I guess in the case if you want to go long, then you get on the bus. And similarly for the local low that we just had, which was the intermediate cycle low from October 6, 2003, that one also was driven down by yields rising, where yields rose to around 5%. And you can look at the other ones. We have some offsetting factor because some of these other ones were going up, but the main one that was going down was yields. So that's really what the focus on. And I suspect as we go forward from this current level that we're at, just below the highs for the gold price, once we get that breakout, it's going to be yields that are going to be driving yields, 10-year yield decreasing. That's going to push it higher. You can look at this inflation premium factor. It is following a trend upwards, and right now we're at the bottom part of the trend. Maybe it comes up, goes higher, but if you multiply these two together and get it so that the inflation expectations for gold are already suggesting it's right, 6%, 5% or so. So it's already elevated. Maybe it goes up a little more, but I don't suspect it's going to go much higher until we get another sort of bout of inflation. And that's not going to occur until there's another big stimulus that would cause that. Yeah,
it's interesting to break all these apart, Chris, because it's, going back to, I think it was 3 charts ago, understanding when the end of an interest rate cycle is, and that correlation to the gold price. Yeah, this one here. Following the Fed funds rate and seeing those gold breakouts, that's interesting to me as well. And really being able to analyze all of these different drivers, I think really puts a pin in understanding all of these drivers from let's say a dispassionate perspective.
Yeah, I think so. And I really like this one. This chart here, the Fed funds rate cycle, it's very simple to understand. And we just go through it real quick. So you get a peak in the 10-year yield. So rates go up, you get the peak in the yields. So we have a peak in the 2-year and a 10-year usually coincide almost to the day, but sometimes off by a couple of days. But then in anticipation of the short-term rates falling, the 10-year yield falls, the 2-year yield falls. And then what you have is gold breaking out. It goes up, driven by these falling yields. We get a cycle high usually at the first half of the recession or an early part of it, a slowdown. And then we get when you get deeper in a recession, things really get bad. Then you get that local low in the gold price. So it dips down. In this case, it was the global financial crisis. And then there's the stimulus that the government does and the monetary stuff that the central banks do, which sort of pumps things up again. And then you get that second local high that occurs later on, and it's usually even bigger. So, and then you go fast forward to the next interest rate cycle. The cycle repeats. You get the 10-year yield high, goes up, the gold breaks out, there's consolidation here, then you get a local high, and you get the crash. In this case, the high and the crash were very close to each other because they just shut down the economy so quickly. But then you get the stimulus, and you get a second local high, and you get up here, and then cycle repeats again. And now here we are. The 10-year yield has peaked. So it peaked in October of last year. And now it's come down. And actually, so if I could just go back, there's another slide here that goes over that. So it goes down. So let's look at for a second. Let's look at how much has gone down in the past when the gold price is broken out. So here we're looking at, say, the 2-year yield and the 10-year yield. So they peaks. So it peaked in October of 2023. And as of February 1st, which was last Thursday, so this is being taped on Monday, the 5th, but so on Thursday, it was down 99 basis points from that high. And the 10-year yield was down 111 basis points from that high. So we can look back, we have 2 previous interest rate cycles to sort of gauge ourselves on what happened. Well, how much did the yields have to go down before gold broke out in those instances? Well, and for the 2-year, it was 102 basis points for the 2007 cycle, and then the 18 to 19 and 126 basis points. And then for the 10-year, down 72 basis points. And then for the 2007, and then down 123 for the 2018, 2019. So you can see that, the yields are already down to a magnitude that is in the ballpark of what it was during past breakouts. So it's just a matter of time at this point for it to happen. Now, I thought it would happen this February based on other analysis. But it, and then I think the markets kind of thought that as well. And then recently they've backed off on those expectations that you would have that March rate cut, which has now been pushed to May. So now it looks like yields are starting to go up again as they sort of oscillate a little bit, but eventually it's gonna break. And I just the follow on that thread. If you look at the futures price, so I like to look at everything from many different perspectives. If you haven't noticed, so look at the futures price, or sorry, not the futures market and open interest. It's also instructive on what's going on. So usually,
Chris,
open
sorry to
interest is
interrupt
going to
for just a
yeah,
second. Is it more instructive over a closer time frame or a shorter term time frame rather than this longer term time frame that we've really been looking at?
It's going to be useful. Well, like an intermediate time frame. So for intermediate cycles, it tends to be useful. So not for daily or weekly, but usually I guess maybe in the monthly time range. But what I was going to show here is that typically in general, as you can see, the open interest tends to make its moves up and then down in sympathy or along with the gold price itself. And that has some intuitive sense to it, because as more buyers enter the market and push the price up, it's going to cause the open interest to expand. And when they exit, the buyers are going to be less and price is going to decline. So that's how you get these ups and downs that sort of correlate with the gold price itself. And you can think of the gold market as, some people are in it for the long run, the gold futures market. And then those who are more swing traders or momentum based and are just in it for the cycle. So if we look the past year, we can see the open interest has gone up and down, but it usually forms these, and this is starting these lows starting in say October of 2022. So over a year of look back on this, and it usually forms these lows, open interest that is. So we're looking at the 5-day exponential moving average, and also the gold, the open interest less spread positions, which is even a little less volatile than the other one. But anyway, they both come down, and they see them coming down and making these lows around this level here. And right now, gold futures open interest is back down to that level, which, at least to my mind, my thinking is that they're probably exhausting all the cyclical buyers that are in the market, are probably exiting at this point. But ideally, we want to see it slow, stop, form a trough, and then get ready to rebound upwards. Because when those buyers come back, because they're cyclical buyers, so they always come back. And you have the gold price on that doorstep of breaking out to new highs, that will be fuel for that movement upwards. So that's one thing to watch. The other thing I watch is open interest. Open interest on the futures, but also on the options, and also the options themselves. So they also tell a similar story. So here what we're looking at is the intrinsic value curves for the current March 2024 gold options contract. And so what is this? So the intrinsic value of an option, let's say a call option. Say you have you bought a call option as a $2,000 strike price, and the gold futures price that underlying it's trading at 2,050, which means that on a per ounce basis, that intrinsic value of that option is $50. Now, if the spot price had been less than 2,000, then it would be worth zero. So anyway, you would add that up, add all those intrinsic values up for every option outstanding at every strike price, and then you would get a curve that looks like this. And it gives you a sense of where the market's positioning for for its anticipation where the price will be. Now, usually on expiration, it's going to fall somewhere within these shaded regions, particularly when you're in these consolidation regions where prices just going sideways. Now, maybe it goes up mid-month, but then usually by expiration, it sort of drifts back into one of these regions here. But what we can see, look at the max pain price. So the max pain price for this is an industry term that they use. Maybe not the best, but that's what they call it, is the minimum of this parabola. And the better way to think about it, instead of max pain, is probably minimum gain. So if you're long, if you imagine yourself owning all the options, put and call for this contract month, then the minimum gain you're going to get would be at this strike price, which is 2025. And if you were short all these options, you would minimize your loss at this strike price. So what we can see, looking at it, it's been drifting up. You can see these the curves sort of drifting towards the right, and it's caused the max pain price to go from 2015, 2020 to now it's at 2025. So slowly drifting upwards in price. And then if you look forward to the next contract month, so we're at March and it's at 2025. The April max pain price is at 2035, and then the May contract is at 2070. And so the May contract is
up.
It keeps going up, and yeah, and if the breakout, well, obviously the breakout level is around 2080 to 2100, and if the options market's already expect or positioning themselves for prices at least around 2070 by the April timeframe, which is the timeframe for the calendar month of April for the May contract, then I would say the anticipation of the market, options market, is that the breakout occurs or occurred already by April. Obviously, it occurred before then, but that's the positioning. So that's sort of an indication of where things are going. And lastly, here's the March contract again, and this is just looking at the open interest distribution. Usually, it's you would see some stuff around where the current price is at, but the high concentration is really all above the breakout level, which was another reason why I was thinking that February was probably going to be a good month that it could break out, because you have at 2100, you have 7,000 contracts, 2150, 5,500, 2200, you have 19,000 contracts. So really, a lot of people were putting their money on these levels here.
And I find it interesting that it's those round numbers that are such high, let's say, conviction or bet placement spots there, even 2125, right?
Yeah.
When we listen to technical analysts talk about these round number price levels, this is a perfect example of, let's say, the psychology of even these traders that are in this market all the time.
Yeah, and I think it's sort of self-reinforcing that once the liquidity is there, then everyone just goes to those to get the best pricing, probably. Yeah. So I think so. Things are looking pretty good for the gold price. It seems like, so right now yields are going back up again because they hit a major resistance level, and but when they cycle back down, maybe they'll punch through on the next go through. And the last thing I was just going to point out, and this again is just look at the gold price, and we have the Fed funds rate and an S&P 500 here. I've noticed there's some people are concerned that the S&P 500 making new highs and that money flow going into the S&P 500 in the stock market in general is a barrier or resistance or a detriment to the gold price breaking out or going up. So, like most things, usually when I hear something, I look into it to see what the data actually says. And if you actually look at the data, so look at after we have the interest rate cycle, after it's peaked, when does S&P 500 peak? So I drew these vertical dashed blue lines to indicate when it peaked for the two prior interest rate cycles, just so we can gauge on how we can set maybe some expectations on the current one. In both instances, in both instances, it peaked after gold had already broken out. So in both instances, and also it peaked after the Fed had already cut rates.
Mhm.
So in my opinion, I don't think there's anything to worry about with S&P continuing to make new highs, because that seems to be the norm. Looking at the prior two interest rate cycles, gold can go up with the S&P going up as well.
Almost going back
Eventually,
to that,
yeah,
the gold inflation expectation rather than this correlation to the S&P or headwind, as you're kind of alluding to,
yeah,
right?
yeah. I think that's the concern that people have, is that it's a headwind.
Mhm.
But it doesn't seem like it based on the actual data that it's really a headwind.
Mhm.
I think gold goes up when it wants to go up. It doesn't really matter if the S&P is getting more money flows or not.
Mhm.
Yeah. But
Yeah,
yeah, that's my perspective.
yeah, it's interesting stuff, Chris, and I appreciate you coming on to explain all of it to us in such a thorough manner. I know it can, you know, showing your work and everything, I know that can seem kind of dry to some listeners, but it's important to be able to look at all of these drivers, A, independently, and B, dispassionately, just based on the data. Chris, I know last year or last time we spoke, you were kind of looking at a $3,000 target for 2023. So how did you know, your thinking around that change, or has it just been, in a way delayed because of the lack of a recession, or what drivers are you kind of going back to understand how that cycle develops?
Yeah, so the expectation there was that the Fed wouldn't be hiking as long as it did.
Mhm.
It would just go up maybe here and then start to roll over, and then you would have it. Um, but obviously that's not what happened. They continued to hike, and which is why everything got pushed out.
Mhm.
But I think this analysis seems to be correct, meaning that using the Fed funds rate cycle as your timing tool is probably better than using these long-term cycles for gold,
Mhm.
um, like the yeah, like the 8 year, the seven. I call it the 7.5 year cycle. Some people call it the 8 year cycle.
Right.
Uh, but using that is probably a much less precise. But this is probably much more precise, at least in comparison, way to look at it.
Mhm.
So the error I had there was in expecting the Fed not to hike as much as it did and for so long. Uh, but nevertheless, now that we're at this point, we see that they're done hiking. We see that the 10-year yield has peaked and yields are coming down. So now we know we're much closer to that point where it does break out. And 3,000 still seems like it's the logical target to get up towards that range uh, for that local high.
Mhm.
And if it does occur, well, I mean, it's definitely going to break out. It's going to reach some level, towards that 3,000. Um, the expectation is that midway through the rate cutting phase, maybe when the 10-year yield gets down to around 3% or so, we get that local high, uh, or maybe slightly below 3%, and then subsequently you get a drop down if there's a bad recession.
Mhm.
So
Eh,
yeah,
I think it's going to be interesting to be able to revisit this chart in a couple of years with you, Chris, to really understand the timing of this, gold's initial breakout move on the reversal of the Fed funds rate, number one, and number two, if that move ends up being proportional to this rate hiking cycle that we saw. It's the biggest and fastest in magnitude in US history. So it'll be interesting to see if that has a proportional effect on the gold price, as you say, towards that, let's say, $3,000 target.
was definitely possible. I mean, even looking at the fundamentals that we said, the cycle high for gold is, if you just project that forward, like 4,000. Um, so there's definitely that headroom to accommodate that without it being overvalued.
Mhm.
Uh, Now, obviously, I don't think it's going to get to 4,000 until there's much more increase in the money supply and pushing those levels upwards. and which that will come. If we have a repeat of this, where you get a bad recession, you get the stimulus, then you get that next big push upwards.
Mhm.
That would be the anticipation later in the decade.
That's exactly what I was going to say. Is that closer to the, let's say, 26, 27, 28 timeframe?
That's exactly right. Yep, that's kind of what I'm thinking too. Somewhere around there, you get the big high, the high that's going to be noteworthy. Put it that way.
That's
But
that's a very, very understated way to say that.
Yeah, but that may not be the ultimate high. Maybe another high later in the 30s. It just depends on how things play out with the fiscal situation and all that.
Mhm.
I mean, or it could be just it makes a double top in the 30s at the same level as it did in the late 1920 or 2020s rather.
Right.
Yeah. So we'll see. I mean, that's sort of speculation, but we can basically doing all this stuff is just sort of get some metrics, so a quantitative way to look at it, so we can not confuse ourselves and see where things are and have it make some sense.
Mhm.
Yeah.
And trying to identify some points where it's probably, best to be able to invest, as you're saying, rather than, trade.
Right.
Um,
And also, you don't want to ride the.
At these
You don't want
points
to.
where gold seems to be undervalued versus some of these other metrics.
Exactly. Yeah. You don't want to ride the roller coaster blindfolded.
Yeah, that's a perfect analogy for it. Chris, your Substack is an excellent source. You do weekly updates as well as these kind of bigger, chunkier data analysis pieces. And of course, that's available at giresearch.substack.com. And that's your main source now, not so much Twitter anymore, right?
That's right. Yeah. Twitter the format wasn't really as conducive to doing this long form stuff. And I think it confused people or didn't convey the message properly.
Mhm.
And also with the change in the Twitter's algorithms, if I ever put a link to the Substack, it gets downgraded and no one sees it. So
Yeah.
I'm not active on Twitter as much as I was in the past, just because of that.
Mhm.
Yeah.
And so just run us through what you do on a weekly basis, what you provide for people that want to read that.
Well, so it's probably more appropriate not for traders who want precise price targets, because
Mhm.
I'm not a trader. I don't do that. It's more of just looking at, as we showed here, what's the options market saying, what's the level. So we saw all the recurring support resistance levels. Where's that at? I tracked the intermediate cycle. Does it seem like we're at the beginning stages or the latter stages of it? So just try to get a sense of where things are at. I'm by no means an expert at it, and again, I'm not in the profession of investments and finance and what have you. So it's just my take for those who are interested. Some maybe not.
Mhm.
Um,
But again, I think
yeah.
that helps take that blindfold off of the unexpected on that roller coaster.
Yeah, and also I think it gives some perspective on, at least helps me out too, in terms of, some people may think, well, price is going to crash to $1,000. It's like, well, you do the analysis. That's very highly unlikely to go anywhere close to that low, because you have the mid-cycle level is going to be a strong support, and it's already been tested multiple times. So we're still in that. And then you look at the fundamentals, everything's sort of lined up. So if you get that, at least you get some reassurance that you're not going to be uh, at the point on the roller coaster where it's just going to drop out from under you.
Mhm.
Yeah,
Absolutely.
so it gives you that broad perspective. Yeah.
Mhm. Excellent, Chris. Well, I want to thank you again. And just to reiterate, if anybody's interested in Chris's work, that's available at GI Gold Investor Research.substack.com. Chris, thanks so much for your time today. Really appreciate it.
Yeah. Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.